If you've been paying attention, you know that we've seen significant volatility in the markets, sparked by the weaker than expected July jobs report and reignited expectations of a recession. So as we speak, the market action has calmed down a bit, but may not be completely over. So what does this do to our outlook, and is your portfolio prepared for what's coming next? We're going to get to the root of it right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore, and we've got Leslie Falconio back in the studio with me, of course, from the Chief Investment Office. Leslie, a lot to break down here. This is Tuesday that we're filming this together, and we have been looking at the market since what happened on Friday with the jobs report that kind of sparked this renewed volatility. I think maybe we could start by just saying if you can explain what we've been seeing and when was the last time we saw this level of volatility? It feels like it's been a little while.
It has. I mean, I would say that probably the last time has been, probably during the SVB in March of 2023. But again, there's a big difference here in the sense that, this isn't some sort of crisis in terms of financial crisis, or there anything, going bankrupt, or is it because of over leverage, or any of these kinds of things. But I do think that part of it is because, or a lot of it has been because of what we saw in the unemployment report, obviously, and the fact that the market is just saying, Fed, you're a little bit behind the curve. We saw this in terms of this was, definitely a snowball effect given what we saw, some of the things overseas and a lot of the unwinds that you and I have talked about, in several of our, of our videos. So what we're seeing now today, after this kind of 2-3 day volatility, we're seeing some calming in the markets now, right? And this is what we all spoke about yesterday, Anthony, when we were on, is that you have these sort of moves, particularly when you have these kind of unwinds, these large unwinds that have a tendency to really get magnified in a very short period of time, and then they there's a calm after that. Now, whether or not the calm lasts is unfortunately what we need to see. And one of the biggest things that we could see in terms of the 10-year Treasury is that, we went to 366 yesterday, now we're about a 385. We had suggested that we'd gone a little bit too far in terms of the amount of cuts that were being priced into the marketplace, the amount of flight to quality that was seen given what we saw, what was happening abroad. But we have some auctions coming up this week. Right? We have like the 3-year today, we have the 10-year auction coming up, and it's going to be interesting to see what the demand is for that auction, given the new yield levels that these buyers are going to be buying them at. So you're going to see from there whether or not people are going, okay, I really want to participate because this could be a trend of slower growth going forward. Maybe this hard landing is going to actually occur. This is not CIO's view, but that's something that we're going to definitely be watching the next couple days. The 10-years tomorrow.
Right. Yeah. And I mean, interestingly, when we sit here together, we're often talking about the Treasury yield, especially the yield curve, and we saw the 2-year Treasury yield drop 70 basis points, nearly one session. 30-year dropped as well. Now they're only about 10 basis points apart, with the 2-year just slightly above the 10-year, so it's around a 395 right now. So it disinverted the yield curve for a little bit. Does that give you any indication that we are maybe past the idea of a soft landing? Could it be less than soft or kind of a harder landing if it shakes out? Because now we've also upped our forecast for rate cuts by the Fed to be a total of 100 by the end of this year. So that changes things a little bit.
It does. I mean, I think that, listen, when we think about the level of the Fed fund rate, right, it's 533 effective Fed fund rate. You've had inflation coming down. So the real effective fund rate is still very high, really, particularly when compared to the 2-year Treasury that you just mentioned. So, our outlook has been that we would have a steepening of the yield curve. We expected a bull steepening, which means the yields come down, led by the front end going lower. The magnitude and how fast the market was pricing in those cuts, was pretty alarming, but no one really thought we'd go to 4.3% unemployment rate. Normally when you have that, you have this initial move, wow, they're really going to have to cut. Some people were talking about intermediate cuts, not us. I mean, that you really need, in order to have an intermediate
emergency cuts.
You would have to have, these emergency cuts. You really would need some sort of crisis.
And we haven't seen, I know the Fed has done emergency cuts in the past, but it's been a very long time.
A very long time. And you really need something that's an issue. I mean, and this is a weak employment number and even some unwinding of carry trades is not a reason why the Fed should do an intermediate cut. So we didn't think that was going to happen. But the market, again, the fixed income market in typical form gets a bit ahead of itself. So it priced in yesterday morning about 136 basis points of cuts for the year 2024. Today it's back down to about 121. So we think 100. So it's maybe one more than that. You might have somebody that has, an extra 50 when we have a 25, and
Right.
maybe it's, in December. But again, you have a lot of data from now till then. We still have, Jackson Hole in a couple weeks. We still have a lot of inflation and another employment number in August before that September meeting. So when you think about the shape of the curve, we think the curve is going to steepen and continue steepening. But that doesn't mean that's not necessarily a hard landing, if you will. It's a softer economic data, which we're expecting, but there's a big difference between being, weaker and weak. And we just don't think it's going to be a weak economy.
Yeah, and also let's remember that there are other fundamental issues that took place, like Hurricane Beryl in the month of July, where something around 436,000 people from that said that they could not work. So that also added to the unemployment rate. So it's a little bit of maybe an outlier there. And you just made a really good point. We have another hurricane happening in the southeast as we speak. So we might see that reflected in the jobs report next month. So let me just pivot here with you, Leslie. As investors, we're all sitting here watching this, little bit of volatility that we've seen over the last 2 sessions, 3 sessions. Is there a pivot strategy here, or are we kind of sticking from our CIO view to what we've all been saying all along, which is look at quality, don't overreact, et cetera. So what are you telling investors?
Well, listen, this has been, given the inversion of the yield curve that we've talked about, right? And we've been in the camp that you should lock in these yields, right? And one of the things that we always said, even regardless of some of the influences of volatility that we've seen recently, is that normally when the market reprices and that reinvestment rate happens really, really fast. It's happened really, really fast. Yeah. So we've been actually wanting people to lock in to, really, because now it's just not about, getting yield, but really having a continuous income stream, right? So you want to lock in. When it comes to our allocation, we still like the high quality, right? Because, this isn't early cycle days. It is later cycle, even though we're not anticipating a hard landing, you're still in later cycle. And we do think growth comes down. But one of the things that we are looking at that might be a little bit of the shock, and we look at some of these, credit spreads that we thought were not only too tight, but also had a certain complacency around them because they weren't moving, particularly as we saw volatility in the equity market.
Right.
So one thing that we're seeing is we're seeing that volatility now in the credit market. Spreads are widening in things like high yield. We're not there where we would say, okay, we want them as most preferred quite yet. But if we get one more, bump in terms of spread widening, we would seriously consider those allocations because now you're getting a decent amount of cushion that we haven't seen in a long time. And because our view is for a soft landing, that cushion should, be enough to really alleviate concerns when we have these little bumps in the road, given the fact that we don't think defaults are rising a bit, they're normalizing, but they're not spiking higher.
Right. So last question, as we've said, we at CIO, our economist, expects now 100 basis points cut over the next couple of months from the Fed. And then I'm sure, reevaluating what's going to happen potentially in 2025, given expectations for this year. So what does the future state of fixed income look like if we consider our expectations and potential for 2025? What would you recommend over the next 18 months or so?
Well, this is an interesting point because what's happened now is that they've taken some of those 2025 cuts and pulled them forward. Okay? Yeah. So now it's really going to be a matter of what the data shows and how the Fed reacts. We do think of 50 basis points in September. The data is going to show, whether or not 50 basis points is actually necessary, and their commentary at Jackson Hole will show whether 50 basis points is necessary. But this, given what we've seen, is going to be interesting because, the market has a tendency, fixed income market, to overdo it, reassess and reprice, right? But given where we are in the cycle, right, if they don't, say, cut that much, it's really going to be a toss-up whether or not, the market says, okay, we're on really strong positioning here, or if they say even stronger, you're not moving, now we're really going to have a hard landing, and yields come down. Now, in between all of that, we have an election. So I do think really depends on a lot of those factors when we look into 2025. Because we are a soft landing outlook, and given the fact we had 10-year yields going to 366, I mean, if we end the year at around a 385, which is our expectation, say it's 350, 385, around that level, depending on election and policies is really going to see how those interest rates move in 2025. I mean, because we're not in a soft landing camp, I wouldn't expect them to move materially lower.
Right. Yeah, and just last quick question, recession, not in the cards.
Not from
right
what we're
now.
seeing right now. We don't. We are for the soft landing again. But I mean, there's a lot of split decisions on the street. A lot of people do think that we're in the Fed has waited too long, and we're not seeing that right now in the consumer with the household purchasing power. What we're seeing in terms of, yes, the personal savings rate was at a 30-month low or something like that about a week ago. So you are going to see a little bit more savings happen.
Yeah.
Okay, which could be one of those indications of the consumer, but the consumer might be more selective. But we still think they're strong. Not as strong as they were, but not enough that we feel causes as a recession.
Yeah, and then on the other side, services sentiment has been really positive. You've got the Institute of Supply Management. It's looking at the non-manufacturing purchasing managers index. They're all showing slight expansion. So again, like as the Fed keeps saying, Powell keeps saying we are data dependent, and then there's a reason because the data there's a lot to digest, and like you said, now between now and the next meeting, which happens in mid-September. So thanks,
right.
Leslie.
Absolutely.
Always good to see you. Thanks
You
for
too.
all your insights.
Appreciate
you. And thank you all for joining us. Lots more information from Leslie and the rest of the Chief Investment Office available on our Insights website. That web address is ubs.com/views. Plus, you can follow UBS on social media. We're on all the channels, including Instagram. Follow us at UBS Trending. Lots of studios content there for you. And as always, if you want to continue this conversation, please reach out to your financial advisor. Until next time, I'm Anthony Pastore. We wish you a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.